welcome everyone. My name is John D'Agostino. I do institutional strategy at Coinbase. It is a pleasure to be here with Travis, Seth, and Gautam. I think you know their background. Seth is with CoinFund. Travis is head of hedge funds due diligence for Albourne, and Gautam is the co-chief executive officer of Brevan Howard Digital. So three very active participants in both building products for institutional allocators, but also understanding what exactly it is they're looking for from this asset class. So we're just going to jump right in. Travis, I'll start with you. So the common narrative around how allocators think about any asset class is they like it to fit into buckets. You often hear hedge fund managers complain, I don't fit into that bucket. And we've heard this for 20 years. So how does that work with crypto? Is that narrative holding? And if so, how do managers respond to that? And do these strategies fit into any risk bucket that allocators are projecting out on?
Yeah, it's a good place to start. So broadly, yes, it still holds as it relates to digital assets. I guess, but somewhat conveniently, at least from our perspective, most approaches we've seen to digital asset trading resemble, rhyme, or close cousins with traditional hedge fund strategies. We completely reserve a space for the new novel aspects of whether it's DeFi or other characteristics that are new and emerging as it relates to digital assets. But that's held so far. It's actually held as how we've approached covering digital assets in the sense that we're a team of 50 investment due diligence analysts, and we take a team approach. We don't have crypto analysts or people who cover quant strategies, cover quant crypto strategies, people who cover long-short strategies, cover digital asset long-short strategies. So we think that model is likely to perpetuate, but I think there'll be expansions to it, as I think we could all agree there's some novel aspects of digital assets that need their own spot.
Great. Gautam, I know you don't publicly disclose how much you manage, but there's been some reports. It's obviously a big launch, one of the largest in the space. How did you think about that? How did you design it to appeal to that slot, that bucket for institutional allocators?
Yeah, so look, I think the opportunity set in crypto has evolved over the last 7-8 years. Initially it started with Bitcoin being the real liquid asset, and rest of the opportunities were really in the VC side of things. And then over time, as more assets have become liquid, there are opportunities that have emerged on the liquid trading side, as well as opportunities where you go long investing in some of the tokens with a fundamental thesis-driven approach. Our view is that value creation and returns will be generated in multiple ways. And right now, the way we have structured Brevan Howard Digital, it's a multi-manager, multi-strategy platform focused on trying to capture return creation across all these three strategies and structure it as a hedge fund, which is where we found a product market fit when it comes to institutional investors.
Got it. Seth, same question?
So we've taken the approach that we're in an evolving space, and they're like Gautam and Travis were talking about. There are different approaches to the space. We've taken the view that institutions will put individual products into the buckets that fit best with their overall portfolio. So we have two venture strategies, one that's early stage, one that's Series A, and then we have a liquid strategy. And the evolution of our strategies has really followed what Gautam mentioned with regard to different opportunities opening up at different times, and we've adjusted the structures of the fund. So our second venture fund was a hybrid fund, because at the time we didn't know if value was going to accrue on the equity side or the token side. It then became clear that you were looking at a diverse equity-driven venture opportunity set. So we started to create different funds around venture while at the same time having liquid in its own strategy.
Right, so a good segue into the follow-on question, which is both you and Gautam decided to incorporate hybrid vehicles. So liquid, open and closed-ended vehicles, private and public investments, or equivalent of public investments. So we'll just circle back with you. That's caused problems in the past, not necessarily for crypto, but just for asset classes. A lot of investors have been burned by the inclusion of privates in a public liquid portfolio. We all know what happened pre-08. It's happened since then. It seems particularly exacerbated in high volatility assets. So why is this time different? Why did you choose to go that way? And what are you putting in place to ensure that the worst doesn't happen?
Yeah, so we approach the private side of the portfolio in hybrid vehicles as being, and again, hybrid vehicle is an old legacy fund from 2018, but we approached it with a balance of portfolio weighting such that if we had volatility on the liquid side, we wouldn't have the private side become too large. I think understanding the volatility of the liquid side going in is really important to making sure that you're sizing the private part of the portfolio in a way that will not lead to those troubles that you alluded to earlier.
Gautam?
Yeah, look, I think fundamentally, in crypto, liquid investing goes hand in hand with private investing because all the tokens that are listed are really VC-like in terms of their journey of where they are from a product market fit perspective or growth perspective. So you need to offer a proposition that allows you to be part of the ecosystem, both on the private side as well as the liquid side. However, as we probably know that there has been issues in the past, the way we structured it is similar to how a typical tech crossover fund is structured, where you have the public side and then you side pocket your private investments in a way that helps you manage liquidity expectations of investors, where investors tend to redeem out of the liquid portion of the book, and the side pockets redemptions take place as and when liquidation events occur for that individual private investments. So we kind of try to solve it in that way, but we truly believe that given where the space is, it's important to be in both public and private side of opportunity set.
Travis, what do you think about that? You're advising large allocators. Do hybrid vehicles make you nervous?
It comes down to, I think, what was mentioned by other folks here is that expectations and clarity on what is it you're getting and what are the both volatility, liquidity expectations therein. And I think it can work. It's becoming more common. We saw it start in credit, and that was natural, and more than drift into equity. And then for this space, I think as Gautam and Seth outlined, there's a synergy that can work. But again, it goes back to expectations. A client has to underwrite it as such, and I think that's one thing that's been improved upon in the industry is clarity and transparency is really.
I mean, if the raises are any indication, it sounds like they're accepting of the model. Okay, great. Okay, so let's talk a bit about the types of exposure. So there's been some great news vis-a-vis institutions in crypto recently. We saw a couple big announcements, obviously Coinbase, BlackRock, Starbucks, Polygon today or yesterday. I think today was Fidelity announced. Obviously the continuation of the bromance between Sam and Anthony with a great deal. From now on, by the way, that's Samphony. That's what they're called from now on. Everyone under 30 who's an influencer, make that happen. Any influencers in the audience? This is a crypto. Anyone who's not an influencer in the audience? That's probably a better question. But there's a lot of great news, right? It's a great deal for Sam, great deal for Anthony. But all of this is kind of, at least for Fidelity and others, it's Bitcoin exposure. It's long-only Bitcoin exposure. Institutions have obviously moved way beyond that. So despite the recent price volatility, I'll start with Gautam this time. What appetites do they have for more idiosyncratic strategies, idiosyncratic asset classes, moving down the curve a bit, away from the top 5 or 10 most liquid tokens? Are you seeing appetite for these sort of out-of-the-box strategies for crypto? Yeah, look, I think there's definitely appetite for return streams that you can get from an asset class like this. Initially it was primarily focused on, as you said, Bitcoin and ETH, but the opportunity set is moving towards the next set of tokens or opportunities that exist. And the market is also starting to, the infrastructure is starting to be there for you to be able to access those opportunities. Like for instance, derivatives used to be a pretty small portion of the total opportunity set on the liquid side relative to spot, but now, as of last month, derivatives were 69% of the market. So that creates opportunities for you to take hedge fund-like investing and trading opportunities, and clearly there's an appetite for it, and hence we are able to offer it. And investors kind of trust us to have the risk management that's needed to be able to do so. Travis, how about you? You see investors, large investors, who decide to allocate to this asset class coming in strong with a multi-strategy approach versus a beta play?
It's definitely evolved. If we think of dollars put to work, it's been predominantly in privates, but the appetite and we can talk about dollars put to work, but the appetite changed mid to late last year where the liquid strategies were more sought, and that really coincided with the institutionalization of a lot of the service providers to those liquid strategies, which was a really important step, and that speaks to the importance of the operational due diligence side of that. But broadly, to your bigger question, yes, the distribution of conversations we have, while we still have some 101 type conversations, we're now having quite a lot of conversations that are far beyond that, the hash rate arbitrage, CLOs backed by ASICs, quant strategies in the space. So the distribution has grown and the median's moved to the more sophisticated end of the spectrum. But I think there's still a long evolution ahead.
Seth, you get to flex your muscles and do some really interesting stuff.
What's really interesting, I completely agree. So we were having a lot of 101 conversations, I'd say 18 months, 2 years ago. And the conversations we're having now, I spent 18 years on the public equities buy side, and the conversations we're having now are about the fundamental drivers of tokens that are at different parts of the technology stack. So it is much more, we're coming into the conversations with institutional allocators that have a much better understanding of what the technology stack looks like, the different competitive products, as they walk in the door, and the conversations are very well informed with lots of good questions.
Great. I'm going to move on to specific strategies for Seth and Gautam, but before I do, Travis, you mentioned ODD. I think it's fair to say that, a year and a half, 2 years ago, maybe 3, your typical crypto hedge fund, if you put them through a typical ODD process, they did not fare very well. Let's just say they were lacking in some areas, like a back office, just for example. How fast is that changing?
Very fast. I have to tip a hat and give credit to my colleagues in the ODD side of our business that they've done a fantastic job of getting up to speed, staying up to speed, and I'd say leading in that area of due diligence. And it's not just the funds themselves, but the whole ecosystem around them has grown up quite a bit. Despite a lot of the lack of clarity in certain aspects, whether it's regulatory or whatnot, it's really made it accessible. We can now have conversations that we couldn't have had a year and a half ago, 2 years ago. It's something that a fund with the commitment to what they're doing can get through, and there's multiple ways to get through, which is a great, opens a lot of doors and possibilities for an institutional allocator.
How much of that is just an evolving thought process on behalf of the managers, and how much is they were down a lot and so they have to react now? It happened before the drawdown, we can say for sure. Good.
But I would say just one last thing is that one aspect of it that I think is still evolving and terribly interesting and will unlock more opportunities is DeFi. It's a hard nut to crack from an operational perspective. I'm sure it's doable, yep. But that's another.
We all said before in the green room, this asset class is showing a remarkable resiliency. I think we've seen some fund closures, but not as many as one would expect, given these price moves. So Gautam, let's talk specific strategies. So what are some of the strategies you're deploying today that maybe wouldn't have worked a year and a half ago due to market conditions or investor interest?
Look, I think broadly speaking, as I said, the evolution of investing or trading in this space started with, investing as VC because there was no public liquid market. Then as there were more tokens that became public or listed, there was interest in just buying from a fundamental thesis-driven approach. I think what's opened up in the last, let's say, year or 18 months is your opportunity to trade around those assets, especially supported by perpetuals that's available on FTX Binance that allows, traders to effectively have long short positions, get basis trading. So some of those opportunities have opened up more recently that wouldn't have been possible, let's say, 18 months ago. Again, they are still largely in the Bitcoin and ETH space because if you look at the volumes, 80% of derivatives are still Bitcoin ETH, but that 20% used to be 18 months ago. So that's gone to 20% of other tokens out there, which we expect to expand and more opportunities from a trading standpoint open up. And look, this is a high vol asset, and there are opportunities to generate return on a net neutral basis. So we try to capture as much of that as possible.
Do you expect that concentration to stay as the overall derivative market grows, or do you think you'll see lots of other products lots of other liquid derivatives products?
I think there will be a lot more such liquid derivative products. In fact, more recently, I think Solana was available as from a options point of view. It's still a fairly, I would say, less liquid market, or there aren't too many options out there.
It's tough, yeah.
But we expect that to change over time.
Look, it's tough. I was head of strategy for the New York Mercantile Exchange, and 80% of our volumes were natural gas and crude, WTI, and we sat in whiteboarded rooms, and we came up with really brilliant new derivatives contracts that solved a really great risk transfer problem, and we'd launch it on the screens, and crickets, like nothing. And what tended to work was, let's just split the contract up and make a mini. And that worked great. So traders seem to like derivatives as opposed to new liquidity pools. So my guess is that we won't see 10,000 liquid derivatives products, but I agree with you, probably we'll start seeing derivatives should trade a multiple of volume of spot. That's how most volatile assets work. So, Seth, what are you doing that's exciting that maybe you couldn't have done a year ago? What new opportunities exist?
So I'll answer that actually on the operational side as well as on the investment side, just going back to your prior question as well. To give you a sense for the transition that we've seen in crypto funds over the last 2 years, 2 years ago, we didn't have a trading team. Today we have a whole trading team, trading ops build out, but we're actually, when we're trading in decentralized exchanges in DeFi, we are getting a rating of the liquidity pool that we're trading with to make sure that it doesn't have any OFAC non-compliance flags. So
you do that internally, or you outsource that?
We outsource that to a service provider. So there's a level of sophistication, that I think has really ramped up aggressively from a compliance perspective, from an operational perspective over the last few years. It also shows that there really is this operational rabbit hole that takes a while to kind of piece together. You don't have traditional primes in crypto today, although businesses like Coinbase Prime start to get you there from a leverage perspective, and they'll start to build out additional functionality. On the investment side, the tech stack, so we're fundamental investors, and the richness of the tech stack just keeps expanding. So for a while it was Bitcoin, ETH, a few other cryptocurrencies. Then you start to have other base layer ecosystems, so think the bottom of the tech stack. Start to have the application layer built out in a more significant way with DeFi protocols in particular. So these are trading protocols, borrow-lend protocols. But now we're starting to really flesh out the middle of the tech stack with things like cross-chain interoperability protocols. And these protocols have value capture. They have revenue. So you can start to apply the same valuation methodologies that rhyme with what I was doing in the equities world for 18 years. And that's a huge change from just 2-3 years ago.
Well, it's certainly exciting, and I'll ask this next question for you and Travis and Gautam, if you want to jump in. But and you're right, but when you say cross-chain protocol opportunities, that's where the hacks occur. That's where the hacks are perceived to occur. So how do you get allocators comfortable with these opportunities? So I'll let you answer, and then I'll go to Travis and Gautam.
Well, I think we're upfront with the fact that we risk manage with position size, and we likely will have hacks of some of the names that we own. When those hacks happen, if the team manages it in what I would consider a best-in-class way, it usually isn't catastrophic or fatal for the protocol. These things happen because this is open source. People see the vulnerability, and the whole community fixes it, so not just the protocol that was hacked, but that vulnerability will tend to be fixed throughout the broad set of similar protocols. And then you manage it with position sizing, making sure that the drawdown that happens on that hack doesn't end up having an outsized hit on the portfolio.
Travis, can pensions ever get comfortable with just occasionally having money stolen?
They might. I mean, TradFi has its, FedWire gets hacked and there's billions out the door. So, it comes back to insurance and other sort of things that you have to factor in. I mean,
it's emotional, right? Because economically, it might be nothing, but it's just the psychology behind it. It's like if a pension is in a hedge fund that blows up.
Yeah.
That's a much bigger political issue than if they're in a hedge fund that loses money and folds and winds down, right? It's a headline risk.
And I think it's the proportionality therein, right? I mean, there are trading errors and the immutability of trading in certain areas, and that makes trade errors a whole bunch more of a something to consider. So I think they can all be overcome. I think the important thing is the pace of correction and reaction to those, and sort of moving it aside from a primary risk. I think we see institutional investors moving very quickly along, getting comfortable with the different strategies within the digital asset ecosystem, whether it's basis trades, quant, or even some traditional fundamental values. It's an interesting, coming from traditional hedge funds, it's a bit of a cliche saying, I have a better model. But you can say that with a straight face in digital asset trading, just with on-chain analytics and all the different approaches to understanding the ecosystem and sort of drawing lines to a price reaction. So there's a lot there. And so I've drifted from your initial question of money being stolen. But I think folks are looking past some of those sort of growing pains, if you want to put it that way.
There's not much difference between a counterparty failure and a protocol hack, right? It's at the end of the day.
If you had exposure to Lehman, it's
yes.
But the hacks that I'm talking about, just to be clear, are like owning a stock and having the company hacked, right? So it could be a 20-point hit, a 30-point hit on the equity, and then there's a path to seeing whether they're going to recover from it. That's not CoinFund being hacked or
of course, I'm sorry, Gautam, how do you think about those risks?
We built Brevin Howard Digital on, basically it combines the principles of 20 years of Brevin Howard risk management experience on the traditional finance side and 6 years of our experience of investing, building and contributing to the crypto space. And what we are trying to build is a firm for the next 5, 10, 20 years. And hence, at this stage, we do not access decentralized finance, specifically for the reasons mentioned here. I think one of the inflection points of when institutional investors will access or get comfortable accessing it would be when there are some level of regulatory standards that will emerge. For instance, there are analytic solutions out there that can assess liquidity pools on DeFi and tell you if there are red flags or not. But you cannot with certainty say that there are no red flags. And hence, there'll be a time when there'll be standards that will emerge, and that's when we'll get comfortable. Having said that, we recognize there are opportunities to capture, and hence, we are creating some of our own frameworks of risk management and trying to educate the right participants in the space. Until then, we are staying away from DeFi, because our belief is that there's enough and more return opportunities exist that in the existing strategies that we operate.
Interesting. Okay, great. No, it always occurs whenever I hear the argument from allocators that they're waiting for regulatory clarity. It always strikes me as interesting because, like, venture capital doesn't have a ton of regulatory. There's not a ton of regulatory clarity around how to invest in early, a kid in a dorm room at Harvard, right? But yet, they're fine pouring money into early stage VCs. But that's. It seems to be selective. To me, we need regulatory clarity is more like we don't understand this and we're scared to admit it, so we're going to wait until we do. But I think it makes sense. At your size, probably the decentralized pools probably don't offer sufficient liquidity to even matter.
Yeah, look, I think if the opportunity set was significantly bigger, you would make enough and more effort to make sure that you are on that side of the regulations. But as I said, there's enough and more opportunities to go after in the centralized side of things that you don't need to really worry about it just yet. Like look at what happened with Tornado Cash, right? Everyone who's even at the second degree of connection is being brought up and there's attention to it. We believe that's not something that we want to edge on right now because there's no need to, because there's not enough liquidity out there. Like even the options market it's just $35 billion on a monthly basis on the centralized side, and it's less than $1 billion. I would say that's also a big number right now on the decentralized finance. So the risk reward is not attractive for you to go all the way and try to take those unnecessary risks.
That makes sense. I mean, and Seth, like it might never be attractive. Like everything can't be liquid. Not everything can't grow infinitely. There's certainly be certain like, idiosyncratic pockets and small pockets of liquidity. Are those places you dabble in, or are you also looking to kind of stay away?
So we do trade on decentralized exchanges. We actually didn't trade on decentralized exchanges for a while. We were waiting for institutional quality ways of interacting, and one of the service providers, Fireblocks, allowed for engagement with decentralized exchanges within the same institutional confines, so biometric approvals by multiple partners, passcodes, whitelisting, that we use for centralized exchanges and moving money between centralized exchanges. This is one of our service providers for doing that, moving between centralized exchanges. So when they offered the ability to have the same controls for decentralized exchange engagement, again, with some of these other tools like looking for OFAC compliance, we started to access DeFi liquidity. We still are very focused on liquidity, so all of our liquid positions are less than 5 days to exit, 20% of average daily volume, which means we cannot buy every asset, we can't buy long tail assets, but having access to DEX liquidity in many cases has brought our slippage on purchases, sufficiently liquid purchases from 10 points down to a point and a half. So some meaningful
even
pockets.
Now?
Even now. So
Great.
some meaningful pockets of liquidity on DEXs.
Great. All right, so we have about 3.5 minutes left. Maybe we'll just end on quick thoughts around where the infrastructure stands. So Seth and Gautam brought up, we're still early stages of building up prime products, and I think that's fair, although I think some have taken a bit of a lead in there. Travis, when you think about the state of institutionalization, custody trading, financing, are we in the first inning? Are we in the fifth inning? Like, when you're advising clients, where do you tell them we are?
Yeah, it's a good question. Probably the first inning. We see a lot of the larger, more sophisticated funds pushing the service provider, saying we need this from you to do this for our clients, and I think that's a healthy way to evolve it. I think LPs are feeling heard by the funds, and they're then passing the needs along to the service providers, and I think that's a fairly healthy way of going about it. I think we have a roadmap from traditional alternatives that help pave that, and just broadly the pace of evolution is so quick. The cliches about internet times two kind of thing. It is happening in all fronts, both investor sophistication, investor interest, the service providers. This period of drawdown or winter, however we want to term it, everyone's been sharpening their knives and really getting their ducks in a row. And I would say institutional investors have been doing the same, such that when the time is right, I think it'll be far different than it was a year and a half ago, 2 years ago, in a positive way for every participant. Yeah. So encouraged by that.
Gautam, what's your view on that?
Yeah, I think this space, is, I would say, one is accessing and managing, investing in the space requires a lot of technology versus, let's say, the traditional asset classes where you have third parties, trusted third parties that help you manage as service providers. So there are two things we do generally, right? So one is we work closely with some of the existing service providers like Coinbase Institution, FalconX, and others, where they are receptive to the feedback that they hear from us, and they help us solve for those problems. But at the same time, one of the things you need is a proper technology team in-house who will actually be flexible and build solutions specifically for your need, which eventually will get scaled with the help of some third-party service providers. But it's still very early.
Right. And that's tough, Seth, because if you're trading on some of these decentralized exchanges, who do you call when you have a problem? And how do you handle, like, your API doesn't work, or there's a trade break, or something, like some equivalent? There's no technical architect to chat with and see why you're lagging or where your latency levels are. I mean, Virtu Jump, all the Chicago Mafia, they're calling up the SIBO like every 5 minutes with problems. They're getting problems solved. Like, since you don't have that, how do you ever get that type of competitiveness? Well,
so for the parts of the stack that actually institutionalize the stack, those are typically centralized. So we do have people that we can reach out to, if that's Coinbase or Fireblocks or anyone further down the stack. So It's a hybrid model. And then there are the teams, when we find things that aren't functioning properly at the protocols, there are teams that you can reach out to at the decentralized exchanges as well. I'll tell you, the sophistication of the operational stack is just night and day versus where it was a few years ago. And we're going to continue to see, I think, a very fast build out of the operational stack over the next few years. So first inning through to 6th, 7th, I think, very, very quickly.
And we are at time. Everyone enjoy drinks. Thank you so much. Thank you.